Hey everyone, and welcome back to Hustle on Purpose. Today, I wanted to talk to you about this concept of risk versus reward. It's an important concept to know and to consider when investing in really anything. It was first introduced to me by a high school football coach that I had, and anytime he asked the question, was the risk worth the reward? You knew the answer was no. Like anytime he asked the question, it was because you had just done something stupid. It had failed miserably and, the ball's turned over, whatever, something bad happened. And it was due to you taking an action that was typically high risk and low reward, which is obviously what you want to avoid. When we're talking about risk versus reward on the investment spectrum, you're typically looking at high risk, high reward, all the way down to low risk, low reward. If it's high risk, low reward, absolutely don't do it. If it's low risk, high reward, hammer that opportunity with everything that you have. But typically you're on the high risk, high reward to the low risk, low reward spectrum. And this exists across all forms of investing, but today we're going to stick to the real estate side of things. You have everything from what I would call vacation rentals, which tend to be on the high risk, high reward side, right? You've got more expensive homes, more expensive maintenance, more expensive management because there's tenant turnover every weekend, and those properties are more susceptible to market conditions, right? People are renting your lake house for $2,000 a weekend when things are going great in the economy. When things go a little sour, that revenue stream may dry up and you don't have the contingency plans that you may have with something else. Because if the economy is drying up, the buyers for those houses have dried up, right? It can go really well when it's good, and it can go really bad when it's bad. All the way down to more of my bread and butter on the affordable rental side, where it's like these houses always have a tenant. Somebody always needs $1,000 a month house to live in. I'm building equity in those things. It's a slow cooker, right? It's the crock pot of real estate. You can set it and forget it kind of thing. And in the middle, you might have medium risk, medium reward with something like short-term rental, where it's like, I've got one right now that's right next to a hospital, which is a great staple in that area. It's one of the biggest employers in the state that I live in, and it's a furnished short-term rental. So that's 3 to 6 month leases. We get a great return every month because it's furnished, it's nice, it's close to the hospital, tenants pay on time, and they move out. We've got higher expenses there because we furnish the place. All of those are wearable products, right? Like sheets only last so long. Toilet paper needs to be put there every time. Those expenses are higher than the long-term rentals where the tenants handle that stuff, but the reward is greater because we make more money on those leases. And you have the flexibility with those middle ground properties where, man, we can rent it out for a weekend if the opportunity presents itself. It's vacant. There's a big, concert in town, or some big event is happening. We can take advantage of that and rent it out for a weekend for a high price. Or if the economy is not doing well, I can take it and turn that into a long-term rental because it's not an extravagant, really expensive property. Somebody could still afford what I would need to charge for that property cash flow for it to be a long-term rental. So those short-term rentals, like that furnished one, for example, the expenses are higher because, sheets only last so long, couches only last so long. Those things have to be replaced and have to be accounted for in your projected expenses over time. But it makes up for it because we can rent it for a higher price. We're offering a valuable service to somebody, a traveling nurse that needs a nice place to stay, things of that nature. So with those short-term rentals, you have the flexibility of being able to do both. You can capitalize on it like you would a vacation rental. If there's a big concert in town or some kind of event happening and that place is vacant, we can rent it out for a high weekend rental price, right? Take advantage of that. If the market goes down, takes a turn, something happens where that revenue stream that we've been counting on for the short-term rentals dries up, we're in it at a price where I can make it cash flow as a long-term rental. Which is really hard to do with those high-end vacation rentals. So it's nice to have some of all of this so that you can capitalize on what's happening in the market and take advantage of that and make it work in your business. You just have to understand when you're buying a property, this risk versus reward, and weigh that out. A thing that's helpful, and it's a rule of thumb of Wall Street, I guess you would call it, is they call it above the line and below the line. So if you imagine a line, and then above it you have risky, and below it you have safe. The general rule of thumb is you want your age as a percentage invested below the line in the safe category. So for example, I'm 33 years old. 33% of my investment portfolio should be in that safe category, which leaves 67% to be invested in the risky category. The reason for that is, the theory behind it is, I'm young, I can weather more of the economic cycles, the ups and downs, and it's worth taking some of that risk while I'm young. Now, by the time you get to, let's say, 65, you want to make sure that you've got a nest egg, you've got a retirement, you've got that 65% of your investment portfolio in that safe category, because your event horizon is closer. You don't have as much time to weather the cycles of the market. 35% can still be risky, whatever. You don't want to be just completely stuck, right? And you want to be able to experience any explosive growth that may happen, but you don't want to bank on it as much as you did when you were 30. Makes sense? So this is just something, it's a rule of thumb. It doesn't fit everybody perfectly. The main thing is you need to be investing. Don't let this analyzing the risk versus reward keep you from investing in something, right? Like the famous quote goes, if you don't invest in anything, you will work until the day you die. And that really helped put a lot of that in perspective for me. Is like, if you're not putting money back in something, if you're not finding a way to have your money work for you when you're not out there working for money, you will work until the day you die. That's the biggest risk. Like, you want to talk about risk versus reward? Try not investing. Jim Rohn had a quote, is like, wait till they hand you the bill for not investing, right? It's going to cost you your freedom. You'll work until the day you die. It's been a really helpful perspective for me. Hope that's helpful to you guys. If you have any questions, leave a comment, let us know. If this video would be helpful to anybody, please share it with them, spread the word. Thank you for watching, and remember, hustle on purpose.